as stocks went higher. Where does that leave us in your mind right now?
You nailed it. A very strong run of data, punctuated by a blowout ADP number today. And I think it introduces this question into the market. Can stocks maintain this almost immunity that we've enjoyed this year, as distinct from last year, to higher interest rates? I think it's mostly the move higher in rates has mostly come from a good place, strong data. We're contemplating might the Fed sneak in 25 basis points here or there, September, November. Very different from the regime last year, 5% in a straight line, including 4 blasts of 75 basis points. I also think kind of an interesting reveal today. Mega cap tech stocks down less than 1%. Our basket of non-profitable tech stocks down 4%. And so I do think there's also this kind of question of what is long duration, what is not. I think we would argue the very top of the index is not necessarily long duration, making the money today, making the margins today.
Yeah, so the very top mega cap growth stocks that have been relatively bulletproof, it seems as if it's just the reliability of the profit streams that the market is paying up for right here. You do see some wear and tear, though, underneath things like banks down another couple of percent. Some of the more cyclical groups, we mentioned small caps. So does it feel as if it's a tenuous situation, or is it just kind of routine pullback? We had a good run.
I think about it this way. If we go back 2 months, the beginning of May, the U.S. two-year note yield's up 100 basis points since then. NASDAQ's up 15%. So again, that's, I think, kind of the correlation shift that we've enjoyed this year, again, in contrast to last year. I think if we look at U.S. mega cap tech companies, it's the story we know. It's the best balance sheets in the world, still generating enormous free cash flow, returning that free cash flow. And then you introduced, of course, in the past couple of months, the right tail in the form of AI. So a big reveal coming through the sequence of earnings, Q2 earnings, the next 3 or 4 weeks. So we're going to learn a lot. But I'd say on net, for anyone who's been around to remember the late 90s, which you and I both do, when the NASDAQ freight trains are running full steam ahead, you really don't want to step in front of them too early.
No, exactly. I mean, especially when you consider, and you'd never want to say that this is an underappreciated part of the market or people don't get all that you just laid out there, except a lot of these stocks aren't back to where they were a year and a half ago, and the overall NASDAQ 100 is not as expensive even as it was a year and a half ago on earnings. So I guess you have to look at both sides there. I wonder how it feels to you in terms of the investor's posture at this point, because you were able to say for much of this year, look, the consensus is very skeptical, underinvested, doesn't own enough in the way of equity exposure. Has that been normalized at this point?
It has. So if we were having this conversation just, say, 2 months ago, I would say the professional trading community, who we know best, have fairly low levels of exposure. I think as we sit here today, that has changed. I think people have more skin in the game today. We can see that in our prime brokerage data. We can see that in CFTC data on S&P futures. We can see that in the options market, call versus put skew. We can see that in sentiment measures. I also think the retail army, if you will, is a little bit more engaged today versus where they were earlier in the year. Our basket of meme stocks is up over 60% on the year. So I do think people are more engaged. If I were to try to put goalposts on, say, a down 10 to up 10 scale, at the peak of the market in 2021, that was a plus 10. Coming into this year, after a very long year last year, of course, -5. I put current positioning at a +5.
Okay. So sort of halfway between neutral and way over our skis, I guess, on that level. How do things look in terms of the setup just into tomorrow's number, in terms of, does this market crave more confirmation that the economy is strong as long as this inflation is still in place, or are we going to be sensitive to every wiggle in yields?
I think there's an element of turbulence that you felt today. So when twos breached 5%, when 10-year note yields breached 4%, again, you felt a pinch in the market you hadn't felt in a long time. I still think in the end, the biggest story of the year, and part of the reason stocks have performed so well this year, is the durability of the U.S. economy. And I think that story starts and ends with the U.S. labor market. We've added 1.6 million jobs. You know, if ADP is mostly correct, that number will be 2 million after tomorrow. Nominal GDP growth in the first half of this year, north of 5, call it 5.5%. So that's been a bulwark for stocks all year, alongside, of course, the mega cap tech stocks that we mentioned. I think in the end, if you ask the market, would you prefer a stronger labor market or a weaker labor market, I think it's shown its hand. It would gladly take, medium term, a stronger labor market.
Does it feel to you, in terms of the way clients are thinking about things, that the soft landing scenario or the, look, there's a recession somewhere out there, but we don't have to worry about it yet, that position has now been fully embraced?
Well, I think if we use the interest rate strip as a signal, it's just pushed it further out. In other words, we've taken back all the implied cuts that were in the curve for later this year. We've taken actually all the implied cuts for the first half of next year. So the bond market is basically saying the Fed's not doing anything probably until the middle of next year, and then it may need to cut 100 in the back end of 2024. I think the equity markets essentially mirrored that as well.
Meaning that that's where the economic downturn risk sits, somewhere out in the middle of next year?
That's correct.
Gotcha.
That's correct.
And then in terms of, like seasonals are only friendly for another couple of weeks. I'm just sort of wondering if we're at a point here where, the consensus seemed to be weak first half of 23, strength in the second half, if we're going to have to work off a little bit of what we've built up in the first half.
So it has been a year where very little's gone as expected, full of surprises. I don't know many people who expected NASDAQ to be off to its best start on record. I certainly didn't.